Okay, so we've now looked at the mechanics behind the order flow that then leads to the price action that we see on our charts. And we then looked at a lot more depth of how those supply and demand zones are then essentially, created on our charts, right? So before we dive into the actual price action, we're just going to go over just a couple of examples that you should be pretty familiar with now, especially if hopefully you have gone through the market structure lessons first. And essentially, all we are now doing is building on those concepts, those theoretical concepts and examples by just overlaying what we now know about supply and demand. So we're going to go through these, and then we'll then hop onto the actual charts in the next lesson, and we'll go through the price action and just apply the actual theory to the price action and show you how it works in reality. So very simply, we should be very familiar with this concept now, right? Price in a bullish trend makes higher highs and higher lows, right? We have the weak highs, so price in a bullish trend, we just expect that bullish order flow to continue, right, until it doesn't. That's the expectation of the order flow, right? So we make higher highs, higher lows, price falls back, it fails to take out the prior low, so then we expect that weak high to be taken, and then price forms a higher high, right? So how do we bring in supply and demand to this? Well, as I was saying right in the previous lesson, supply and demand zones are literally created everywhere. Every time there is a shift in price action, whether that's a range, then price breaks out, or whether it's just a pivot, just one candle, so on and so forth, right? And then price changes direction, there will be a supply zone within here. You see price change direction here, there'll be a demand zone within here. But at the end of the last lesson, what did we look at? We looked at there being two main ways in which we can use to validate whether a zone will be strong or weak, right? So there's loads of things that we can use, loads of concepts to increase the probability of zones that we may want to build trade ideas around, or zones that we may directly want to enter on, right? But the two main things that we'll be looking at is zones that cause breaks of structure, and then zones that cause flips. But we don't need to worry about that now. We're going to get into that in a few lessons shortly after. So for now, this lesson, of course, is purely concentrating on those structural zones, the zones that cause breaks of structure. So like before, when we purely were just looking at market structure and we're looking at the concepts of strong lows down here, right, and then a weak high up here, the reason, well, when price breaks up through that weak high, right, this then becomes a strong low. We have that confirmed higher low, and because it took out that high and it did its job, what do we expect? Well, after a break of structure, we expect price to pull back, and we expect it can come down as low as it wants. But in theory, it shouldn't break this low, right, if the bullish trend is going to stay intact, and that's what we see. And now we can just overlay our supply and demand concepts into that. So, of course, when we see that pivot and that movement in price direction, demand is obviously created here. But because then price, after that pivot in price, because it then goes on to break that weak high and cause that higher high, that demand zone that I have drawn on here, right, then becomes a strong demand zone. And that is one that we would draw on our charts, and we would be very much interested in when price comes back to it, to then look for a potential higher low to form, to then catch the next swing run, right, to take out this weak high. So in the meantime, right, whilst we're then seeing demand being respected, as those higher lows are then coming back into those strong areas of demand that cause those breaks of structure, at the same time, what's happening is those supply zones, because remember, every time there's a shift in price direction, supply will have been created, because at that point, for price to pull back, what's happening? Supply is overpowering demand. So although demand is in control, at those pivot points, at those turning points, supply is actually stronger there just to make price pull back. So a supply zone is created, all right, and you can draw these on, and you can see them on your charts. But what you should expect is you should not expect price to hold, right? We may get a bit of a reaction, but ultimately we would expect supply to fail and for price to form that higher high and get that break of structure. And that's why we're seeing here, right, supply just keeps failing and demand keeps holding, right, until it doesn't. So looking down below, a bit more of a realistic example of kind of how price moves, right? We don't always get those utopian nice big swings in price. As we can see here, right, bit of a complex pullback. Price then pulls down to the origin demand zone, right? The origin, that apex of the move, right, that caused the break of structure, that caused supply here to fail. And then we get the movement back in. We start to get our minor breaks of structure to the upside, right? And then we pull back. And then we reach that supply zone. So remember, it's supply, but it's not a strong supply zone. Why is it not a strong supply zone? Because it never took out the weak low. It never caused a break of structure. So in reality, what you'll see a lot of times, like I said before, all supply and demand zones will typically have a reaction. Now, sometimes price will literally smash straight through, okay, but generally there'll be a bit of reaction. Now, there's a whole spectrum of what you could define as a reaction, because price could literally come in, pause for a candle, and then go, or you could get a bit of a pullback, which is what we see here, right? So supply looks like it's initially being respected, but what's happening is it's just causing a reaction. Price then comes back to mitigate this sort of minor area of demand. The reason why I say it's minor is because it only caused a break of this minor high, right? At this point, it never caused the break of structure. But then when supply here, right, those sell orders are filled, it's just enough to cause a little bit of a reaction to come back to this minor demand zone. And then that's enough for price to then fuel this move to the upside, right? Because it's filled enough of those orders, those sell orders within this weak supply zone. It's a weak supply zone because it never took out the low. So all it's doing is it's mitigating it. It's filling up those orders, which means it's removing now any little bit of supply there in the market. So then when price comes back into this newly created minor area of demand, there is now nothing left up here. There is no sell orders to stop price now just smashing straight up through and continuing the overall bullish trend, right? And demand stays intact, okay? So then when price actually causes that break of structure, in reality in the market, there's generally more than sort of one demand zone in which you can mark on your charts, in which would be valid for price to come back to, because in this case, we have this initial demand zone, right, that caused that break of structure there. So that's definitely valid. And typically we call these the decisional demand zones, so ones that are higher up in the leg. But you would also have, if I just drag this across, you would have a valid demand zone down here, right? And this would be the origin, this would be the apex. So when price has just caused that break of structure, and then you're looking for price to pull back and form that higher low, right? We don't know where that higher low is going to form. So we can outline, potentially more than two, right? There could be multiple demand zones that were formed within this entire swing leg, right? So in this case, we have two. We have one here, the decisional, and then we have one here, which is the origin or the extreme, right? Depending on what you want to call it. And we will never ever know for certainty where the true swing high low will form, okay? So we can do things to increase the probability of where price may pull back, right? We can overlay premium and discount, right, so on and so forth. We can start to use tools. We're going to look at other things, right, series of mitigations, liquidity and stuff, which we haven't really covered in too much depth just yet. But the point I just want to make right now, to keep it simple, is essentially be aware of your strong areas of demand. They're both strong because they're both part of the leg that caused a break of structure. So in theory, price can form a higher low from either of them, but at a bare minimum, right, you should get a decent reaction from this demand zone here. So that's still tradable, or you can use it for your information, right, that you can look for a long. It potentially may be short-lived, and then price may want to come lower, mitigate this area, and then go. But as you can see here, it doesn't have to. It can respect demand, and it can go there. So this will just be something that comes with time and experience, collecting data, backtesting. It will also vary from pair to pair. It will depend on when you overlay multiple time frames, and you're combining all of the concepts that you know. But for right now, all I just want you to kind of think about is just that sometimes there will be multiple areas of demand, right? And we don't always know which one the swing high low is going to form and continue that next move, right? And then this demand zone down here, as we can see, wasn't used for now, but when price can come back down at a much later point, then potentially we can, I've drawn that a bit too far, but when price comes back, we can look for, potential bullish reactions from down here, okay? So yeah, that's essentially it. Purely just looking at it from, just market structure, from a very, very basic market structure standpoint, right? Just one time frame, overlaying those strong demand zones around those higher lows, right? Because they cause those breaks of structure. And this is why, it's so important to get market structure correct first and have that really nailed down. And that's why we spent so long doing it, because if you start just drawing on, any old supply zone and demand zone, and then suddenly you're wondering why you're getting smashed all the time and they're not holding out, or the reactions are very small, well, it's all because of your market structure, right? And what did those supply zones actually cause? How significant are they? Yes, supply stepped in the market here to initiate that pullback, but that's all it did, right? It didn't achieve any major breaks of structure. So yes, it caused, this price to do this and have those substructural breaks to the downside. And that's why we get a bit of a reaction here, because there will be some decent amount of supply within there, right? So you can trade this if you want to, but you just have to manage your expectations, right? It's a quick in and out trade, target the next minor area of demand, and then we can look for the true break of structure to occur. So then looking over here, right, it's just the exact opposite for bearish order flow in a bearish market, series of lower lows and lower highs, where the lows are weak and the highs are strong because they are taking out the lows, they are causing breaks of structure. So when we get those pivot in price and we get that either range created or pivot created supply, and that supply then leads to a break of structure, right, showing that demand is failing, supply is in control, when price pulls back up to it, we expect supply to be respected. We expect that high to hold, and we expect the next swing run to go to the downside and take out that weak low and take out any demand that may be there, because supply has been respected, supply is in control, and that is what essentially shows that bearish order flow right in the order book, and that's what is then translated into the price action, why we see lower highs and lower lows. So a bit more of a realistic example down here, right? We have a bit more of a complex pullback. We pull up into the apex of that move, right? The origin of the move that caused that swing break of structure there. So supply then holds. We try to come down, doesn't initially go break that structure, right? Potentially, there can be some very minor demand within here, right? And why is that minor demand? Well, because it caused that substructure break there. So you may see a bit of a reaction. It could have reacted from any of these points here, and this is why all of these supply and demand zones that I'm drawing out within these minor swings, you will see in a live market will cause some sort of reaction, right? Whether it's just a pause in price before it goes, or whether you see a bit of a bounce. But you have to understand, right? If you're too zoomed in and you think that this is a bullish trend, but you haven't actually marked out where your swing points are and realize we are in a bearish market, that's why you can get thrashed around if you're just purely looking at supply and demand. Even if you're pairing it with going, okay, it took out this high, this demand level should hold and we should continue this bullish trend. Well, no, it's not bullish. That is a bullish pullback, right? This section of price action within the bearish trend. So once price has done its job, it's pulled back up into the premium, it's mitigated the strong supply zone, right? It's picked up all the fuel that it needs to then generate that next move to the downside, to get that next swing trend to the downside, right? To cause that break of structure. Then all of these demand zones here are going to get smashed. Yes, there may be some tradable reactions from here that you may want to trade, but you just have to use that information to manage your expectations of which way price is going to go, because supply is in control here, not demand. And that's why we're seeing the swing lower highs and lower lows, okay? So price comes down, potentially reacts from some very minor demand in here, it pulls back, and then breaks that low there. So even though that's just a minor break of structure, price then comes down into the origin of this move here, right? The origin of the pullback, but it's still a weak demand zone because it never caused that swing break of structure, right? It only led to these internal breaks of structure, those minor substructure breaks, right? So then when price comes here, it's just a short-lived reaction. It picks up more supply, right? This is reasonably strong supply. It's just caused a minor break of structure. It's not as strong as supply that causes a swing break, but because it's pro-trend, right, you can then still take these trades from here and anticipate that supply is still going to be stronger than this area of demand. So when we saw that reaction from demand, let's get rid of these drawings, right? It's now filled up any demand that may be left in this area that caused that pullback, right? So now that demand has been mitigated. When price then comes down and it picks up that strong supply, now supplies are firmly in control because there's nothing left down here to stop price just smashing through and continuing that overall swing trend to form that lower low, right? And then so on and so forth, we pull back up. And this is where, just like I was saying with demand, right? This is the decisional demand supply zone. And then we have the origin, the extreme up here. Both are valid. Obviously, if price was to come up higher, this zone is always going to be higher probability. It's more well priced, it's higher up, but also because if price comes up here, right, and we look for the shorts, if we're wrong, right, and it fails, well then that's it. We've got a bullish trend change, right, because price then would have formed a swing higher high. So you're getting in at the best possible place, right, to know whether or not you were going to be right or wrong because you're getting at the highest point. Whereas with the decisionals, you could get in short here, it could work a little bit, but price can still come all the way up to this swing high right at that point, right, up into that extreme supply zone and hold before we go. So this will just come with time and experience of whether you're interested in these decisional demand zones or not. And like I said, as we go on, we're going to introduce more and more concepts so you really get a feel of how and when you wish to trade the decisionals rather than potentially waiting for price to come up to the origin extreme, which means you could have a high strike rate, but it also means you may miss all of the moves where it reacts from the decisional, and then we then go to then form that lower low and cause demand to fail once again. So that's kind of just a very, very basic market structure that we've looked at. Hopefully you guys should be very comfortable with that from a pure market structure point of view, and now we are overlaying demand and supply into that. So let's take a look at one more example and then we'll hop on the charts. So this should be a price action example, right? Obviously drawn with a line diagram, but one that you should now be hopefully very, very familiar with. And now what you're going to do, of course, is build on this even further by introducing supply and demand into essentially what is a multi-time frame market structure example. So let's go through this slowly and look at what's going on. So this big sort of thick grey line, this dark grey line, is the 4-hour chart. So we are clearly in a 4-hour bullish trend we form that higher high, pull back to form a higher low, and then we get that break of structure. So what do we expect after a break of structure? We expect a 4-hour pullback. How do we know when that 4-hour pullback is going to kick in, right? So how do we know when the swing run is over, and how can we increase the probability that potentially that 4-hour pullback is about to kick in? Well, the first thing that we looked at was we were looking at those changes of character. So if we were purely just looking at the 4-hour chart, right, and we weren't using multi-time frame analysis, what would we look for? We would look for a minor low to be taken, right? We would look for that minor break of structure to the downside. Now, when you see that 4-hour change of character, that 4-hour emboss, if you were to drop down to the 15-minute chart, which is this blue line, not always, but most likely, that 4-hour minor break of structure, that 4-hour change of character, will most likely be a 15-minute change of trend, because this tiny minor 4-hour pullback, right, denoted by the green line, if you look at this pullback here on the 15-minute chart, it will most likely, right, be a big deep pullback on the 15-minute chart. So that will most likely be a swing low on the 15-minute chart. So then when we get that 4-hour change of character, that 4-hour minor break of structure, that will most likely be a 15-minute swing boss, right, a true break of structure. So then the 15-minute is now bearish, right, because it needs to facilitate that 4-hour pullback, right? So that's kind of the first thing that we've really looked at in terms of market structure to help us time the end of swing runs and anticipate those swing pullbacks kicking in, right? Now, what is the other thing that we can now introduce to our trading to help us anticipate not only ahead of time of how far this swing leg is likely to go and when the swing pullback is likely to kick in, but also give us a lot more confidence that when we do see that initial change of character, that it isn't a full signal, that we are actually about to see that. Because of course, we could take out that minor low, it can just be a liquidity grab, and straight away that swing run can continue to go, and then we get the true change of character, and then we get the true pullback. So what is that thing that we can use to help us increase the probability that this isn't a full signal, and how can we anticipate that ahead of time, to help us potentially with management if we're already in a position? Well, as I'm sure you've already guessed, we're going to use supply and demand. So just got these up here, which I'm going to drag and drop over. So in this case, right, we're looking at a 4-hour, bullish trend, right, with this big thick line. So very typically, what is most likely going to initiate a 4-hour pullback? Well, it's most likely going to be a 4-hour area of supply, right? A 4-hour or higher. So it could be a daily, a weekly, a monthly, right? They're the types of higher time frame zones, right? So the same time frame or higher for the 4-hour is most likely what is going to end the 4-hour bullish swing leg up, and then it mitigates that 4-hour area of supply. And because it's a 4-hour area of supply, that should be strong enough, right, to kick in a 4-hour pullback, right? And that is what we can then use to anticipate ahead of time, right? Because this would be from old price action onto the left, where potentially we had price trending down, and then this 4-hour zone, right, caused that swing low there, and this essentially would be an old 4-hour swing high that would then, it's still fresh, that we're drawing that across, and that is where there is still supply in the market for price to come up and mitigate and then kick that pullback, right? So that's essentially why I've got this drawn all the way off the chart. So again, just to go over that, 4 hours bullish, we get the break of structure, we expect a 4-hour pullback. How can we know that 4-hour pullback is about to kick in? We get a change of character or a lower time frame trend change, but we can anticipate where that is very likely to happen ahead of time by looking where there is an old supply zone that is still fresh, where there will likely be a lot of supply, old orders to be filled to initiate that pullback, right? So then we get that break of structure, and we can start looking to play that pullback if we wish to do so, right? How far can we target? We can target anywhere within this 4-hour discount, right? When we mark out the high to the low, we mark out the EQ of the range. Discount prices are where it's going to be highest probability that price will want to pull back to form the high low, right? But remember, it's probability. It does not have to pull back that far, which I'm sure you're all now very familiar with if you have done that testing, right, on the pair that you're looking at, where you've collected data on that now. So at this point, we've got our change of character. We're initiating the pullback. We can think we can target down to discount. That's pretty much all the things we've looked at so far. But what is another tool that we can use to potentially anticipate how far price may want to pull back? Well, we look at this fresh 4-hour demand zone down here, right? And we can anticipate that it's likely price is going to want to come down to pick up all of this demand. That did what? Why is it a strong demand zone? Because it led to that break of structure, right? It caused this bullish swing leg. So when we see that change of character, we can anticipate that price may want to pull down into the discount, right? This whole discounted range, and to mitigate this 4-hour area of demand to then kick in for that high low to get that next break of structure to the upside. So at this point, what we can then do is jump down to the 15-minute chart when we see that change of character, where potentially the 15-minute chart has now switched bearish. And what will most likely happen is you will see those 15-minute supply zones. So why is that a strong 15-minute supply zone? Well, because it caused that 15-minute swing low, right? To cause that 15-minute bearish trend change, then you see a series of mitigations, right? If you're looking on the 15-minute chart, you can see that at least from a 15-minute perspective, the 15-minute supply is in control, right? We're seeing a series of mitigations. They're being respected. The 15-minute chart is making lower lows and lower highs, right? So you can potentially want to trade this. You can, put the premium discount on this M15 leg here, right? Wait for price to pull back up into the premium of that M15 leg, right? So you are trading pro the M15 bearish trend, right? Because the M15 is bearish, and you can look for these shorts. So it's pro M15, but you have to be aware of what? You have to be aware that the 4-hour is bullish. It's just a 4-hour pullback. So you have to manage your expectations of how far price is likely to go, even though it's pro M15 trend. Because at any point, the 4-hour could plant in a high low, start to break to the upside, and then the M15 will switch bullish, okay? So, at a bare minimum, you can target this weak 15-minute low. Why? Because it never took out that strong M15 high, right? So that's kind of your minimum first target. Then you can start to target the EQ of the 4-hour leg, and then you can push it even further down into where you can see 4-hour areas of demand, okay? Now, when we get down here, right, and we start to get into the discount, you can anticipate, of course, that price does not have to pull all the way down to that origin or the extreme, remember, and we could start to go. So if you see price start to pivot to the upside and potentially, you draw on some demand, if I can get this to come across, right? Now you have to ask yourself, yes, you can see the candle and you can see there was a range or a pivot and price broke up to the upside. And yes, that is technically M15 demand, but is it strong or weak demand? Well, it didn't cause, on this example here, it didn't cause any break of structure, not even a minor break of structure. It didn't do anything, right? So when price comes back down, what are the probabilities, what are the odds that there is enough demand within here to continue that move to the upside? Well, it's pretty slim, so it's pretty likely to be a weak demand zone. So what I'm just going to do here is just kind of denote that by kind of drawing a hollow box, right? And then we can see that supply is still in control and it easily takes out that demand zone. We get another minor break of structure, right? And then we come down to the downside. So yes, in theory, because we have continued that move, right, we have created strong M15 supply here, right? Because what's happened is, purely from an M15 perspective, the bearish trend is intact. We've taken out this weak M15 low, right? That swing low. We've created a lower high that should in theory be an M15 strong lower high. So then when price comes back up to here, right, and it smashes straight up through, right, if you're not understanding all of these concepts, understanding multi-time frame market structure, understanding strong demand zones, understanding premium discount, you haven't realized that we're in the discount. We've mitigated strong 4-hour demand because it's caused a break of structure. The higher time frame trend, right, the 4-hour trend is bullish. It's very likely the higher low is going to be intact, right, because it shouldn't breach this low here. But if you're just looking at the M15, looking at the M15 bearish trend, seeing there's a strong M15 supply zone, right, you're going to get smashed a lot of the time, not always, but most of the time, because 4-hour overpowers M15, right? The amount of demand and orders within here, nested within this area of price action that led to a 4-hour break of structure, is going to be much stronger than the amount of supply that it took just to break this weak M15 low, okay? So that's why price may come up and it may react initially, but ultimately we can expect price to smash up, right? And go there to the upside. So let's get rid of these orange drawings. So now what do we have? That M15 change of character, right? Which then from a market structure standpoint can indicate or give us more probability that that 4-hour high low may be in place, especially now as it has mitigated that extreme area of demand, right? It's all systems go now to start to anticipate that that 4-hour high low may be in place. So we don't just want to buy straight away. Of course we can, but we want to increase our accuracy, increase our strike rate, and increase our reward to risk ratios. So what do? We can jump down to the M1 timeframe because we are anticipating what? We're anticipating that M15 pullback, and we want to catch the M15 high low, right? We want to see that M15 low is not breached, and we want to see a higher low, and that's what we want to trade. So we can mark out, right, the EQ of this leg here, wait for price to pull back into the discount, but we don't just want to buy there straight away. What do we want to do? Well, what we did before is we waited for the M1 to switch bullish, right? We waited for that M1 change of character to the upside, right, to indicate that now potentially, because the M1 has started to switch bullish, then the M15 high-low may be in place and it's in the discount. What's the next tool that we now know that we can use to increase the probability? Right, we can look for price to come into that M15 area of demand, right, that stepped in to lead to that M15 break of structure that caused that M15 change of character. So when we see that ahead of time, we've now got three tools, right? We've got premium versus discount. We've got price coming into our area of demand to mitigate this area of demand that needs to hold, right? If that's going to be a protected low, we then drop to the M1. We see the M1 switch character as well. So M15 demand's been mitigated. The M1 has now switched bullish. Okay, wait for the M1 to pull back down into the discount. But what else can we use on the M1? We can then use the strong M1 demand, right? That led to the M1 break of structure, that led to the M1 change of character. That's in the origin or the extreme of the move, that's sitting in the discount. And then boom, this is where we can get long and we can enter. And we've used all of that confluence across multiple time frames to then get long. And then we can target that weak 4-hour high, right? So, you know, in theory, there may be some, if I draw it on right, there may be, you know, an area of 4-hour supply up here that's potentially still fresh, right? Because it did still cause that pivot. It caused that minor breaker structure here. It did initiate that pullback. And, you know, there may be a reaction from here and we may want to trade that, right? We may want to take this short and play a bit of a pullback. Or if we're in a long position here, we can take the short here to hedge our long position in case, you know, sometimes price may reverse, right? We never really truly know that. It's not high probability, but it may happen. But ultimately, we should expect that it may just cause a reaction. It may just fill up some demand, right, that was created on the way up. And then ultimately, that weak high should go because price has done everything it needs to do down here if the 4-hour bullish trend long term is going to continue. But yeah, hopefully you guys, you know, should be pretty familiar with this kind of overall price action model here that we've been looking at. But all we've now done is just overlay supply and demand zones in there across multiple time frames to help not only help us initiate ahead of time how far price is likely to go, but then also when price is in here and we start to see those signals, right, with changes of character and breaks of structure, it can increase the probability that this wasn't a fake, a fake signal, right? And then price can keep going higher, right? Because it's mitigated a strong area of supply. So it increases the probability, right? It's not a guarantee, it's not a certainty, increases the probability that we can now look to either play those counter trend shorts or, you know, manage any positions if we're already in long from down here. So hopefully you can now see how all of these pieces of the puzzle, you know, are starting to come together as we're building it on layer by layer. So I think that's everything I wanted to mention at this point. What we'll now do is go back onto the charts that we've already marked up on euro dollar, and we're going to start to apply these concepts. So what I would say, if you're feeling pretty confident and you want to have a go at this, go now on the price action that we've been looking at on euro dollar or whatever pair you've been looking at, and now go on there. You know, take one time frame at a time. Start on the way up, right? Start at your highest time frame on the weekly or the daily, right? And draw on your supply and demand zones, right? You should already have your structure marked on, and just see the ones that are respected, see the ones that are not respected. The weak zones, right? So i.e. like this weak 4-hour zone we just spoke about, you know, see, does it get a reaction, right? Or does price spike through? If it does get a reaction and price pulls back, does it pull back to an area of demand on a lower time frame, right? Start to see all these things, you know, start to see, okay, price pulls back here on the 4-hour chart into this demand zone. Is there a way, instead of me just entering here with a really wide stop, is there a way I can then jump down to a lower time frame and then wait for that to switch bullish, see if that comes into M15 demand, and then when it comes into that M15 demand, drop down to another time frame and see how the M1 reacts, right? You know, it doesn't really matter what time frame, right? It could be the weekly, the monthly, you know, the 30-minute, the 1 hour, whatever. It's just, right, price is fractal. I mean, see here, right, if we did this with the 4-hour, the M15 and the M1, and we still weren't 100% sure that this M1 zone was going to hold. But what can we do? Well, we can jump down to the 15 seconds, right? We can wait for the 15 second to then switch bullish. And then what do? We mark out 15-second area of demand, and then we get in there because it's giving us a little bit more confirmation, right? That this M1 zone is going to hold and it's going to go. And you could just, you know, in theory, keep going down 5 second, 1 second, right? I wouldn't recommend necessarily doing that, but that is literally what is happening again and again and again, right? The 1 second has to switch bullish before this entire move can happen, right? It happens first. But of course, you're going to get a hell of a lot more, you know, full signals, which is why we always start on the higher time frames for our overall directional bias. We outline those highest probability areas, and that's what I was saying in the lesson before, that I'm only jumping down to my execution time frames, which for me at the moment is the M1, right? I'm literally not going below the M15. I'm waiting for all of this to happen, price to get down here before I'm even thinking about the M1. It's only when I see everything being mitigated that I want to, you know, expect to be mitigated. I'm seeing those breaks of structure that I'm then just using for that final little bit of timing and the icing on the cake to then get positioned and try and increase my reward to risk ratio as much as possible. So I'll leave that there before I waffle on any longer. Let's hop on the charts, let's get practical, let's look at some realistic examples, and really see if we can put this all together.